Joining me now is Aneta Markowska. She's chief financial economist at Jefferies. And Aneta, what do you say to those who point to the yield curve among all the other factors I mentioned and say, this Fed is going to tighten us into a recession?
Well, the Fed hasn't even, hiked a single time yet. So at this point, I think there's no debate that they need to get started. I think the signaling will be very open-ended. I don't necessarily think that they're going to commit themselves to a series of hikes, but I think the rhetoric is going to be such that inflation risks are just greater right now than growth risks. And I think it's reasonable to expect, 25 BIP increment moves at pretty much every meeting this year, but the risks are skewed toward faster rather than slower. Because again, I just think that inflation expectations here are really at risk of de-anchoring, and that has to be the number one priority at the Fed.
What about China? I mean, you see what's going on there. If they can't control the spread of Omicron and they stick with zero COVID, they're going to have to shut down bigger swaths of the economy. Shenzhen already is a major global manufacturing hub. Shouldn't we expect to see a ripple impact on demand and supply?
That's right. But again, I think, it's a question of which one of those risks is sort of a bigger issue that the Fed needs to address right now. And the fact is that, we are kind of looking at a backdrop where you have supply shock on top of supply shock on top of supply shock. And the consumer's response so far has not been to cut spending. And, in fact, that survey from this morning that your previous guest alluded to says, the consumers, they're not saying, hey, it costs me more to buy gas, food, therefore I'll have to spend less on other items. They're just saying we're going to spend more. We're going to cover these increased costs, but we're not necessarily going to cut spending. And that means that, even if it starts out as a series of supply shocks, demand is sort of sustaining those inflationary forces. And again, I think that has to be the number one concern at the Fed, because at this point, it's really their credibility on the line. And look, I think also we have to keep in mind that the Fed started this year with a baseline forecast of 4%. So even if you sort of assume a worst case scenario on oil and then you add these supply shocks, chances are that we're still going to end up with an economy that's growing above trend. And again, inflation that's just way, way above where the Fed really wants to see it. And so I think
Sure.
To me, the outcome is pretty clear.
So to kind of sort of capture your points, you say the oil shock, not significant enough to put a meaningful dent in U.S. growth. Some dent, but not a meaningful one. Risks to inflation are much greater. The actual inflated data points show broadening price pressure. So let's just leave it with your inflation forecast at this point. We've seen scary headlines about how the CPI could be 9% in the next reading. But what's the more significant takeaway that people should have in mind when it comes to what the dynamics are for inflation right now?
Yeah, look, whether we peak at 8.25%, I don't think that's really sort of too relevant. I think the bigger question is, are we going to see second order effects on inflation? And our base case before the war was that inflation would slow, but to 3% by the end of the year. We thought that the labor market would put a floor under core inflation around 3%. And if we do get those second order effects and these energy and food price increases start to feed through, you could potentially end up higher. And that means that, even if part of this inflation story self-corrects, there's going to be a significant chunk that doesn't, and that will ultimately have to be squeezed out by the Fed.
All right, Aneta, we'll leave it there. Thanks again for your time. It'll be a big week. We appreciate it.